Intro. I will read each headline topic and then relay the key details in a clear, listener-friendly script. Each topic is presented in 4 short sentences that preserve the core details provided. 1. Market and geopolitical story driven by the Iran war. Higher oil and jet fuel costs boosting energy profits while disrupting travel and shipping. Since Feb 28th, after U.S.-Israel attacks on Iran, the Strait of Hormuz has been effectively blocked, cutting Middle East crude and jet fuel supplies and risking weeks to months to fully reopen due to mine clearance and vessel reallocation. Oil and energy earnings have surged. Shell reported Q1 adjusted profit of $692 billion, slowed buybacks and a small dividend increase. And renewables players like Vestas, Ørsted, and Equinor have also reported stronger results as energy security concerns shift investment to cleaner supply. Jet fuel exports plunged. April down 30% year-on-year, recent weekly loads down 50%. European jet fuel prices roughly doubled to about $187. Airlines' fuel bills spiked. U.S. carriers spent over $5 billion on jet fuel in March, up 56% versus February. Maersk warned of huge shipping costs and delays. About 1,500-plus vessels and some 20,000-plus crew are estimated trapped, and U.S. refiners are redirecting production, but Asian refineries remain highly Middle East oil dependent. 2. Markets jumped and oil plunged after reports the U.S. and Iran are close to a deal to end hostilities. Stocks rallied on reduced geopolitical risk, S&P 500 plus 1.5%, NASDAQ 2% to record highs, Russell 2000 plus 1.5%, Dow up over 610 points, while oil saw a dramatic intraday move. WTI fell as much as 15% to near $88, and Brent fell 11%, before settling with WTI at about $95.87% and Brent at 101.27, 10.8%. Retail fuel and heating oil also eased, wholesale gasoline down 5%, heating oil down 6%, but prices remain far above pre-war levels. Year-to-date oil is still more than 65% higher, and U.S. crude and fuel stocks continue to trend down. EIA crude stocks around 457.2 million barrels, with a weekly draw near 2.3 million barrels. Markets remain vulnerable to contradictory reports and comments. If a firm agreement materializes, the geopolitical premium could unwind quickly, but failure or renewed conflict would likely send prices back up and keep volatility elevated. 3. A failed security effort, Project Freedom, has left roughly 1,600 ships stalled in and around the Strait of Hormuz, highlighting supply chain fragility. The Trump administration's Project Freedom was halted after 48 hours, with only 2 merchant vessels actually escorted, leaving an estimated 1,550 to 1,600 ships and about 22,500 crew effectively stranded in the Persian Gulf Hormuz area. Shipping firms avoid transit because escorts are temporary, and many war risk exclusions mean insurers often won't pay. Insurance premiums have jumped from under 1% historically to roughly 3 to 10%, and attackers have struck about 32 vessels so far, with roughly 10 fatalities reported. The International Maritime Organization warns that military escort is not a long-term fix. Iran insists on war cessation and lifting of blockades and has proposed new transit rules and fees, and the overall choke point is disrupting 20% of global oil flows while driving up insurance, fuel, and food fertilizer risks. 4. Energy and commodity swings. Lithium prices rebound and Albemarle beat estimates. Oil is volatile on Middle East tensions, and LNG demand charter dynamics firm up. Albemarle reported Q1 net income of $319.1 million, EPS $2.34, adjusted $2.95 versus $1.99 expected, with lithium revenue up about 70% to $891.2 million as lithium prices jumped toward 51% and sales rose 14%. Supply is tight due to Chinese mine outages, a Zimbabwe export ban, and falling carbonate inventories, while the company keeps capital spending around $550 to $600 million. Oil rebounded to roughly 102 TBL of Brent and 95.8 WTI amid mixed diplomatic signals and a 2.3 million barrel weekly crude draw, sustaining price volatility. LNG sees a shift toward long-term charters as firms hedge transport